Good morning. It's the 22nd of August. We are Signal Centre talking ball. I'm Joe Neighbour, joined by Steve O'Hare. Good morning, Steve. How are you?
Morning, mate. Yeah, very good. Very good.
Good. Excellent. No, Jamie this morning's got a day off, so just be us two oldies going through what's going on with the markets today and how we are setting up for the week ahead. Certainly a bit of pressure this morning. It looks to be the case on the stocks in particular. Obviously, we'll get to that in a moment. But first of all, we will go through the latest headlines and what's behind these moves today. So starting off, first of all, with the Eurozone current account surplus that slid over the weekend on Friday. And we saw the number for June move quite substantially lower compared to the expectations. The 12-month surplus still narrowed and to 12 billion euros and 0.9% of GDP. So that's certainly creating some anxiety, it would seem, at the moment. In terms of the UK confidence, that continues to deteriorate as well. Further major concerns over the impact of extremely high UK energy prices, especially with the countdown to the October spike in prices continuing. Industrial action in pursuit of higher wages also reinforced the lack of confidence. We're seeing that across many sectors at the moment. And as a result, we've seen sterling slip to 6-week lows. On the other side of that, we've seen the dollar continue to strengthen. That's now up at 5-week highs, with a lack of confidence in the Eurozone and the UK currencies helping provide support for the US dollar. In terms of the CFTC data, this comes out once a week, just gives us an indication of where the market is positioned at the moment. It's something we put a lot of weight on and something that we regard as a key metric when looking at markets. The latest recorded data showed a net increase in euro short positions to near 43,000 contracts, and the largest short position since March 2020. And as we know at the time, that was pretty much the height of the pandemic where it initially kicked off, where we saw that massive amount of volatility. So that's not a great sign at all. We've seen China cut rates again. The Chinese central bank sanctioned another rate cut in interest rates, with the 1-year LPR rate cut to 3.65% from 3.7%. So just a minor adjustment there. Markets had been expecting a steeper cut. So again, that's probably helping underpin the dollar again today and creating this weakness that we're seeing in stocks. The global PMI data is due tomorrow from the US. And the UK and the Eurozone. Actually, we've got a number of major economies reporting on that. The latest PMI data will be monitored closely when it comes out tomorrow. The consensus forecasts are for a further net deterioration in conditions in the Eurozone and the UK, with a recovery in the US Services Index from a contraction seen last month. And it's a big week in the US as well, because we've got the Jackson Hole Symposium, which is kicking off on Thursday. That's when we're expecting to see the Fed Chair Powell make a speech. The comments on monetary policy will be crucial for market direction. So it is promising to be quite a lively week potentially. But let's get stuck into the charts on this Monday morning to see what's moving and if there are any opportunities in varying asset classes. So Steve, do you want to kick us off with Bitcoin?
Yeah, sure. Diving into the longer term chart, first of all, we'll look at the weekly chart, and we can see last week's bearish outside candle, which is very negative for price action from a technical perspective. And that remained, we were looking at that Friday with the talking about the possibility of a bearish outside candle, and it followed through Saturday and Sunday. The market underperformed and prices moved lower. On the daily chart, we can see that we've broken clearly now below that 21-day moving average. We're below the Ichimoku cloud again, although over the last couple of days we've seen a little bit of a recovery. It's not been enough really to stem this negativity across the market. So overall, really looking for this to extend lower, this price to extend lower. Resistance will be coming in around about the 21,763. That's yesterday's high, and really looking at this, or really focusing on this 20,700 to 20,770. There's a little bit of a range there to look at. That's the support area. That goes back to the 26th of July low, and obviously Friday's and Saturday's low. So that's the level to watch on the support side, 20,700. A break there should open up further downside, and we could potentially at some point this week, if we are going to sort of continue this like indices sell-off, could see real pressure in the cryptocurrencies. Looking at Ethereum, that's also setting itself up for some sort of bearish flag, bearish pennant on the short-term chart. That's moved away from the real resistance level, support stroke resistance, the real pivotal level around 1730. And again, looks pretty negative overall. Still above the Ichimoku cloud, so it's outperforming a little bit on the technical side in front of Bitcoin, but still looks negative overall. Further downside expected there this week. Taking a look at commodities, and the daily sell-off continues. We've got now, well, this is the 6th potentially negative day of price action in gold. We've broken through the support at 1755 we were looking at. That broke through on Friday. Got down to 1745, but we extended lower this morning, being down to 1741. Further downside expected there. Now, support really thinking about that should come in around about 1730. But again, I think the rejection of the rally from last week really is sort of like hammering home this bearish channel that we're in. We really have formed a really nice, quite a strong trend line now, and we're below the 21-day moving average also. So it feels like at some point we will get a retest of this 1680 support level. If we look back, we can see how important that's been historically. So yeah, plenty to see there. Silver, that's also below the 21-day moving average and rejected gains above the cloud, and resistance coming in here around about the 1956 level, which was Friday's high, and also a reaction level that we got back on the 5th of August. So started off on the back foot this morning. Again, you can look back here and we can see there's really buying, selling going on previously. So we will have this area of support all the way down to 1814, trading at just around $19 at the moment. So silver on the back foot. Also, copper seems to be sort of bucking the trend in commodities on that sort of like metal side of things, and we're still focusing on this resistance coming in at 370. Although price action today has been rather negative so far. So we've seen Thursday, Friday, the rally from the 21-day moving average, but giving up the Friday's gains and looking to target Thursday's price action also. 21-day moving average coming in at 355. Looking at crude oil now, and we are at quite a crucial level also in crude oil. We saw the rally on Friday and it stalled at this 21-day moving average. This has really proved to be a really classic point of resistance on this sell-off, and we can see numerous times where price moved through the 21-day moving average or stalled just in front of it or at it and rejected and moved lower. We've got the 92.27 is the serious resistance level above, and that was support previously, now resistance, and it's holding it pretty well. So we're in a nice bearish channel. We could actually draw a nice bearish channel on there. Let's take it from here. You can see multiple touch points if we bring it down to here, and yeah, looking pretty negative overall on crude oil. We're hoping that filters through to our energy prices, but it looks a little bit ominous for the future. We'll have a look at natural gas in a minute. The Brent crude oil also, that this trades at a premium, trading around about a $6 premium to WTI crude oil. Same sort of price action we saw on Friday. The stalling at the 21-day moving average again proved to be quite a decent resistance all the way down on this sell-off. Looking back, we've got the real support previously at 95.43. That was since we've been through there, we have pivoted around that sort of level. And if we look back, really, the sort of like we're looking at, we've probably got real support about $10 lower from here. So if we do manage to get below the $91 level, there could be quite a fast move, because we'll have some sort of vacuum on pricing there. Natural gas, that continues to hang around these multi-year highs. That's a resistance coming in around about the 950, 960 area. And we're just stalling around there. Positive day on Friday, not too bad start to this morning's trade. Opened a little bit lower and moved higher. Support coming in at 890, and above, obviously, resistance all the way up to 960. So natural gas, which is probably the real driver of these the energy crisis, is really clinging to those highs, and it doesn't look good, Joe.
No, indeed. I think we're seeing a bit of risk off across the board, really, across a number of assets. And one of the most prominent things that we look at when it comes to risk is the dollar index, because if that's moving higher, that indicates that there is a shift in people moving towards more defensive assets. And that's what we're seeing at the moment with the US dollar. Broke out of this channel, which looked to be just a corrective one, a very minor correction. In the grand scheme of things, as we can see, the overall trend remains very strong indeed. So we pull back to close to a 50% fib level, or just overshot that a little bit. But since hitting that level, then breaking out through this corrective channel, it really hasn't looked back since. We are posting consecutive higher closes on the dollar index to close at the highest level in 5 weeks. So we're fast approaching this previous high that we saw at 108.74. In fact, we got a little bit higher than that. We hit highs of 109.29, and that was in mid-July. So it looks as though we're going to get a fresh challenge of that number. Above that level, we do have a 78.6% Fibonacci retracement at 110.25, and that goes back some time, really, I think, to the lows that we saw in the back in 2018, to the highs that we saw well before that. And actually have to go to a weekly chart to find them. Which was back at these highs that we saw in 2001. So pretty significant levels approaching, but you wouldn't be backing against the US dollar at the minute, considering what we're seeing really across the board. We got the rate cut that was less than expected in China. We've got weaker consumer numbers and confidence numbers coming out of various countries, and of course we've got a key this week ahead with regards to monetary policy from the Jackson Hole Symposium, which I'll come on to in a little while, about what that means and what it actually is. So looking at Euro US dollar, obviously that continues to weaken. Overall trend remains very bearish. We are fast approaching parity yet again on this. We're only 20 ticks away from it as things stand at the moment. Now, the first approach we saw on this back in July on the 14th, we saw parity defended very well from the speculators. It wasn't really anything to do with it being a technical level, more that it's just a big psychological number, that one that we see on the chart, which obviously we haven't seen for some time. So it looks like we're going to give that a good going over again pretty shortly. And if we do make new lows and take out the ultimate low that we posted on the 14th, which was at 99.52, then that would indicate that we are going to see prices continue to slide to the downside. The next major support we've got on the chart, again, I have to scroll some way back to the left-hand side to find it. We've got a support level that goes back to around here, actually. So it's actually even lower than that. Which was a significant high that we posted back in 2001. So pretty scary stuff for the euro, and not looking as though the selling is going to slow anytime soon. We may see some defending again by the speculators around the parity level, as it worked so nicely last time. But if it does break below this low that we posted at 99.52, then it looks like we're in for lower prices. Taking a look at cable, we can see that is fast approaching the lows that we posted again back in July, the low being 117.59. If we take that out, then we're looking for lower prices yet again with this, down to potentially 114.10. This red line that we've got highlighted on the chart, and if we go back to the left-hand side, we can see that was the low that was posted pretty much at the height of the pandemic when it was all kicking off, and that's down at 114.11. So pretty significant levels that we are potentially approaching here. And if we break below that, there isn't really a lot to prevent it sliding lower over the short to medium term. Taking a look at dollar yen, we can see that continues to march higher. It's broken out through resistance, which potentially could have formed some sort of top pattern. We can't rule that out really until we take out these highs that we posted on the 14th of July at 139.38. But it's a bit flat today. It's certainly off of its best levels as things stand at the moment. But again, the overall trend remains extremely positive. So it's a difficult one to bet against right now. If we take a look at the commodity currencies against the US dollar, we saw a bit of a correction higher in New Zealand dollar versus the US dollar, but that's broken down and prices have continued to move lower. It is up today by around about 0.5%, only really recapturing half of the losses that we made on Friday with this. But quite clearly, we can see a sequence of lower highs. Are we going to get a lower low? Well, this is the level to watch. It's at 60.60. If that gets taken out, then there's a fair amount of white space on the chart for that to move into on the downside. Let's take a quick look at Aussie. Similar situation. We saw a corrective channel. We've broken through that. Yes, we're higher today, but it needs to do a pretty good job of engulfing all of those losses that we saw on Friday for there to be any sort of encouragement about that moving higher. So overall, everything looks very much under pressure against the US dollar as things stand. Let's move it on to the indices. And if we take a look at a few of these today, starting off with the ASX 200, we can see that prices rallied pretty substantially towards a 61.8% fib level at 71.61. We've come up just shy of that, posted a bearish engulfing candle on Friday, engulfing all the gains that we made on the 18th, and we look to be rolling over here and moving to the downside. The overall trend, I would say, looks pretty bearish. Potentially some sort of topping pattern taking shape here as we're seeing on a number of indices, but the Aussie is holding up quite nicely actually compared to particularly US markets at the moment. Take a look at the Euro Stoxx 50. We posted a large top pattern back here, which actually completed in February. Since then, prices have been very choppy. We've seen a number of tests of this key low down here around 3,390. We've seen a decent move to the upside, which now appears to have broken, and we are heading lower, it would seem. Similar situation with the DAX. We completed a small double bottom. We broke up through that quite impressively, and then we moved higher towards a 161.8% extension of that double bottom pattern before failing, and prices on the back foot today down by 0.35% as things stand. The US markets, we've seen a gap on the all sessions chart on the NASDAQ. We are down by 0.64%, so very much under pressure today. We do have some support at 12,941, so it'd be interesting to see if that can act as support as it did here back on the 9th of August. If that gets taken out, then it looks as though we are continuing this sequence of lower highs, and we can start expecting moves back down towards these lows eventually at 11,035. Looking at the S&P 500, similar situation, not got a gap on the chart as we have with the NASDAQ and actually with the Dow as well. But this looks as though it's rolling over. Interestingly, on the 4-hour chart, there was an interesting setup here. We've got a nice bullish channel that we can see here on the 4-hour chart, and look to have completed a head and shoulders top here. And that simultaneously broke down at the same time it broke out of the channel. And since then, prices have continued to move lower. So that doesn't paint a particularly positive picture for the S&P 500. And obviously being 500 stocks as opposed to the NASDAQ, which is 100, or the Dow, which is 30, this is probably a really interesting barometer for the entire health of the US economy as opposed to those other indexes. So be cautious, I think, with regards to stocks at the moment. Just have a quick look at the Dow. Go back to the daily chart. We can see here we've actually gapped lower today and taken out this bullish channel at the same time. We do have some horizontal support at 33,478. If we start moving below that, then I don't think that would be a particularly encouraging sign, and again would indicate that we may see a little bit of unwinding of this impressive bear market rally that we've seen take place over the last few weeks. We'll finish off with the FTSE 100. This continues to be pretty boring compared to everything else, but it is holding up on a relative basis quite nicely. It's hugging around a 78.6% fib level. If we can take out support at 7,491, then that may trigger a bit of a correction in the short term. But overall, this is holding up quite nicely. But on a stock specific level, there are quite a number of stocks that are suffering, as we're seeing elsewhere in financial markets. And obviously, this is being propped up a lot by the commodity stocks that are involved in the index, as well as the banking stocks. So it's not really a great index to watch at the moment for an indication on underlying health of the UK at the moment. So that will do. We're not going to dive into individual stocks today, just because Jamie tends to look at that. So we're just going to keep it more broad. When Jamie's back, we'll start looking at a few individual names. Yeah, we'll give you a picture on how that looks for the rest of the week. Steve, anything to add at all?
No, nice little roundup, Joe. And just one question we've had from Ryan: are there many indicators that work well with Forex? I would imagine that most would work well with shares, as I would think Forex is based on fundamentals. Could you give a rundown of what indicators you might use? Just a couple of your most valued ones. Good question. And really sort of just brings us back to really what we use technical analysis for. I mean, overall, it is fundamentals and news that drives markets. Technicals for us is a tool that can be used to give you good entry and exit levels. And yeah, so one of my favorite indicators that I use is the Ichimoku cloud. Doesn't really give you a lot on the market I'm showing you at the moment, but let's try and look at it from it's a really messy indicator, but when it works well, it really keeps you in the trend. What it does also, it gives you forward support and resistance levels. A lot of indicators are more historic, so this projects previous price action forward, and it tells us that in the future, so where support and resistance will be. There's a lot that goes on into this indicator. This is a whole show on its own, where you can use multiple strategies within one indicator. But it really, for me, it gives you a really instant look at where what the trend is, and maybe where you should look to get positioned if price moves towards this cloud and interacts with it. So that's my favorite. Joe, what's yours?
I mean, I tend to just use a lot of horizontal levels really on markets, and when we see big breakdowns or levels that have been tested on numerous occasions, I tend to put obviously more weight on those. I also like using the 10-period exponential moving average as a bit of a short-term indicator. If we see any sort of closes or impulsive closes above or below the 10-period moving average, that tends to be a pretty good signal for me, just to try and capture some short-term momentum. But ultimately, I think more classic approach for me, just using patterns that appear again and again and again. And if you want to check out what some of those are, there is so much information available on the internet. But just Google classic technical analysis patterns and try and spot a few of those. And I think you can't go too far wrong. But ultimately, any good strategy is only as good as its risk management. So making sure you have stops and making sure that when you're targeting your exits for your trades, you need to make sure that they are typically at least 2 times bigger than what your risk is on a trade. So from a risk reward ratio perspective, making sure that you're looking to target much bigger winners than if you were to take a losing trade. And losing trades happen. I think if you focus on that approach by having rewards that are 3 or 4 times bigger than your the amount of risk that you're taking, you don't have to have particularly high win rates on your trades. And I think, as Steve mentioned there with his indicator that he likes, the Ichimoku cloud, that's really good at keeping you in the trade for a long period of time. And having that patience to run with a trend is really what's going to set your set you off on your P&L and make a massive difference.
Yeah, I mean, even just like simple things like the previous swing high, the previous swing low, and using that as your strategy. It's always sort of like quite exciting when you see a sell-off like you do on a Monday morning in these indices, especially. And there is a big temptation to just dive in straight away. And as we saw in the Nasdaq, I think you mentioned the Nasdaq, Joe. They sort of like there was a gap on one of the charts that you showed. I'm not seeing it on this one. And markets tend to fill gaps. So instead of sort of diving in straight away, think about, a lot of the time when I'm sort of like maybe trading conservatively, I would really look to where my stop would be before I think about the entry. It's very much about what Joe said: risk reward, trade management, really sort of focusing on where you think you will be wrong. And sometimes it means that you miss a trade. You might sort of like miss that entry level and sit there, and the market continues to move hundreds, thousands of points lower when you sort of just were waiting for that the perfect entry level. Sometimes you do miss out on trades like that. But yeah, it's all about building a trading plan around what suits you. Lots of traders may not be able to trade the same way as each other. Some have more patience, some have more risk tolerance, and it's really sort of like working out what works for you. So just any it's trial and error. It's you can't sort of like buy the experience, I suppose. But yeah, start off with a dummy account or a demo account, and then sort of like slowly introduce capital when you think you're ready for it. If that's that's the sort of like way to do it properly.
Indeed.
Patience is a virtue.
Yes, absolutely. Okay, thanks, Steve. So let's move this on, and we can maybe further highlight what we're talking about here with regards to risk reward and trading plans, etc., and also the impact of win rates on your trading account as well. So this is the gun to the head challenge, which we participate in every day that we do these videos. When it's obviously the three of us, we post 3 trades, but today we'll be posting 2. The idea is that we pick a trade idea live on the video. We don't give it too much thought or reasoning behind it. We're just looking for patterns that we can maybe identify in very short-term charts, in the hope that they play out between now and 9 p.m. UK time, or when the stop or the targets are hit. All of these ideas are placed at market. Each of the ideas must have a stop and a target and a risk reward ratio in excess of 2 to 1. If anybody wants to follow these trade ideas, it's very simple to do so. You can find them all on our TradingView profile at signal_center. And we publish them up here with a little bit of blurb as to why we've come up with these ideas as well. So on Friday, it was very equity focused. All of us actually posted ideas on equity indices. Steve went on the DAX 40. And he was looking for a further sell-off here, a little bit of explanation why, along with the key levels. And it's very easy to also monitor how these ideas played out just by clicking that play button there. And we can see in this instance, Steve was looking for a risk reward ratio of 3 to 1 on the DAX. And if it plays, we will find out that Steve was actually nicely on side with this by just over 1R. Doesn't look like
Computer
he wants
says
to
no,
play
mate.
ball. It does say no. Let's have a look at Jamie's idea. He was selling the Russell 2000, the small cap index in the US. Looked to be playing out with a bit of maybe a flag pattern there or a continuation pattern to the downside. He actually hit target on that, as you can see there. So that played out really nicely for him. And at 9 o'clock, he was, he hit target there at pretty much at
Yeah, it
the
was early.
expiry. Yeah, so well done to him. That was a 2.77R win. And I was trading the gap fill on the Euro Stocks 50, and that played out quite nicely as well. I think it was 1.7R on side with this one.
Nice
So
one.
collectively, it was a really good day for us. We don't always win on these trade ideas. I would add that caveat in there. Actually, if we look at the spreadsheet that we're maintaining on this, we can see that typically win rates are around 41.7% across the 3 of us. But all in all, we are producing some pretty impressive returns collectively between the 3 of us. We did have another participant, Ian, who was involved in this for a while as well. But we're well over 100% on side with these trade ideas with a win rate that is well, a lot of people would consider not good enough, but we know that's not the case because we always focus on risk reward. If you look at individual analyst performance here, we can see I got off to a very good start, then went through a pretty big sideways period, which I would argue I'm still in. But Steve, you are smashing it at the moment. It's a really nice upward trend on your
You're
gun to
trying
the
to
head
put
trade
a
ideas.
bock on it, Joe.
Maybe.
I know your game. I
Yeah,
know
it's all
your game.
psychological, right?
It certainly is. Yeah, it's just sort of like sometimes as well. I sort of feel like when you have a little bit of a break, like a bit of a holiday, you come back and you're a bit more relaxed and you're sort of like not sort of like so engrossed in everything that's going on in the market. And sometimes you can see how trade ideas are playing out. And yeah, it feels like since I've come back of holiday, it's done quite
It's all
well.
clicked, isn't it? You're just
Yeah,
seeing it all, aren't you?
yeah, my win rate is like poor compared to you guys. Well, below 40, which, yeah, like you say, most people would say, yeah, below 40%. That's rubbish, mate. But it
Yeah.
can work out if you have the right risk reward trade management behind it. It does work out. I'm
The other
stalling
thing,
a little bit here as well because I'm sort of like looking at DAX. I want to sell DAX.
just
Uh,
before you get onto that, Steve, I just want to highlight about pips as well, because we hear it so often, particularly with new traders, they're focusing on pips. Whereas if you focus on risk reward, you don't even need to consider pips as even something to count, really. You
yeah,
focus on risk reward. Steve's posted 612 trades on the gun to the head challenge that we've done. So it's a fair sample size that we've got there. He's got a win rate below 40%. And the amount of pips, if we counted them all up, and all the trade ideas that he's done, he's down 3,600 pips, but he's still up 43.6 R in that period. So for every 1% that he's risked overall, he's making 43.6, which is, a significant return. So don't concentrate on pips, concentrate on risk reward, and concentrate, on trying to maximize your returns versus the risk that you take.
and that's a lot to do with compounding as well, Joe. The reason that's performance shows it's so from trading experience back in the day, I would sort of have a trading account. I would have a few winning days. I would take the money out. I wouldn't change my trading size. I would just stick to the same whatever I felt comfortable with. I'd risk £100 a trade or something like that. And then if I was to compound that, my returns would have been a lot better.
Yep.
You sort of you're building that. You're growing that account size and risking according to percentages. So risking 1% on £1,000 account and risking 1% on a £10,000 account, you'll quickly see the difference, especially when you have that good run.
Yeah, exactly. So, by using the percentage approach, if you're successful and your account starts to grow in value, then you are risking larger amounts per trade, but it's still relative to your account. It's still risking 1%. Whereas if you risk a fixed amount and you go through a period of drawdown, you're still risking outsized amounts compared to what your account is worth. Then it can really start compounding on the downside if you use that approach. So use the percentage approach would be our advice. So risking 1% or 2% of your capital per trade in order to try and make multiples of that. That's I think going to have a much bigger impact on your performance overall. So Steve, we've waffled on enough. Now we've got to pick a trade idea for the trading session ahead. Have you got anything in mind?
I have, and as I said, I think waffled too much for me. I was really looking at selling the indices. I looked at the DAX. I'm going to look at S&Ps now, S&P, because it's just broken down in the last few minutes through this previous support. And as you can see here, for me, that is a vacuum area which could accelerate the sell-off quite quickly. Again, waffling too much. Could have got into this a little bit at a little bit of a better level. Let me dive in now. The stop will be above this 42.20 area, and the target, I'm going to move the target down to this level here. So it's going to be about 2.5 to 1. Let me get it to expire at 9 o'clock. Yeah, selling S&P at 4,192, targeting a move to 4,120, and a stop at 4,220, giving us a 2.56 to 1 risk reward.
Best of luck, Steve.
Cheers.
I'm going to take a look at Bitcoin. So just looking at the 4-hour chart actually here. So for me, it looks like we're in maybe some sort of corrective phase with this, but I'm not sure how long it's going to last. Sorry, that's a really awful drawing. Let's capture those lows, capture that one there. So it looks like we're potentially about to break down from this channel. This is on the 4-hour chart. If we draw a horizontal level on here, we can see I'd expect this to act as resistance now. So we've seen a pretty impulsive breakdown below that key swing low that we posted on the 4th of August. And also, again, using sort of classical patterns, arguably what we're in the process of doing here is forming some sort of flag pattern, which would indicate a continuation lower in price. So yeah, if you want to check out classical patterns, then channels, flags, top patterns, head and shoulders, double bottoms, etc. These are the sort of things that I would typically look for in a trade idea. And also, if I apply one of my favorite indicators, the 10-period exponential moving average, what I can see is that we've seen a close below that over the last hour. We've still got another 24 minutes before that's actually confirmed. But because I've got guns on my head, I've got to do something. And I'm actually speculating on this moving lower, breaking out of the trend, potentially forming a bearish flag. So I'm going to sell it at the current price of 21,241. I've got a stop loss above the swing high that we posted at 9 o'clock last night. That was at a high of 21,795. So my stop's going to go at 21,881. And I'm going to target a move down to some support levels below, which I think I picked this level here. So this low that we posted on the 13th of July, that's at 18,911, which gives me a risk reward ratio of 3.62. So for risking 1%, I'm looking to make 3.62% on this particular trade setup today.
Excellent. Good luck with that, Joe.
So they'll be posted up to our TradingView profile. If anybody wants to check them out, please feel free to do so. And as we mentioned, you can monitor the progress of those throughout the trading session if you wish. Okay, let's move on to the data today and what's expected from the day ahead. Let's have a look at the calendar. So we've got some PMIs due out. We've just had the German one out. I haven't seen what number that's coming at the moment, but given what we saw on Steve's DAX chart, I can't imagine it was very good. Looking at the UK at 9:30, so just under an hour until that's out. And then we've got the US PMIs due out tomorrow. So a number of manufacturing numbers that are due out, which could impact the overall sentiment in the markets. The main event this week is the Jackson Hole Symposium. People may have heard people talking about this. It is an annual event in which dozens of central bankers, policymakers, and academics from around the world get together to discuss economic policy. So it can have a pretty important say on market direction. That starts on the 25th, with the Fed Chair Powell expected to speak on the 26th. So we could see some volatility towards the end of the week as a result of that meeting. Okay, Steve, I think that's pretty much it from us today.
Yeah, nice one, Joe. We survived without Jamie.
We did, yes. We can do it.
Excellent.
Yeah, hope that was useful, guys. We'll be back tomorrow with some more. In the meantime, please trade safe and have a fantastic day.
Cheers, everyone.
Catch you tomorrow.